Do you know what is the US equivalent of India's subsidy bill? I call it the quantitative easing or QE. The last time the QE was unleashed, the wave from that drowned growth in all economies across the world, leading to a decade of extreme disturbance. Now, as the shockwave from the collapse of the Silicon Valley Bank spreads, expect another round. Yes, the US Treasury Secretary Janet Yellen has said she is not going to give a bailout. But we shall look at what does that exactly mean. It doesn't mean that the QE is not going to happen. And essentially, remember one thing. California, where Silicon Valley Bank was located, is a blue state. It accounts for the largest number of US seats in the House of Congress. The government cannot afford to just let it go like that. Indian subsidies for food, fertilizer and petrol are rightly pilloried by the rating agencies. But remember, their effects are confined to our shores. And in the recent years, the India government has tried its best to cut down some of those. The effects of QE are, however, global. When dollar waves sweep across the markets, interest rates go down, and then after some time comes up, those are major missiles. They're worse than the Russian missiles that are hitting the Ukrainian shores. And that is what we are going to discuss in this issue of On Point. As we speak, the stock markets around the globe are badly spooked, as this data shows. But you know what is the root cause of this problem? It was because both the USA and the EU misread COVID. At the initial stage of COVID, when the vaccines were not coming, the markets were closed. What both markets did, and prompted by some do-gooder economists, was stuffed cash in the pockets of people who didn't have any chance to shop. Now, what did that do? That cash was just a placebo for the vaccines that was taking time to come, for the ill health that was taking root, which is why I call it a subsidy. But if only cash could drive away COVID, it didn't. Instead, when the markets opened, people went out and shopped. And what did that do? It created inflation. And what was playing in the background? Well, that cash which these governments were giving out was essentially borrowed, which meant that the governments were raising bonds from the markets and giving out cash. And who were subscribing to these bonds? Banks like Silicon Valley Bank, banks like any others. Bonds were all over the place, they were cheap to buy, and everybody was very happy. After all, what can be more secure than a US government bond? But then, as I said, inflation struck. And when inflation struck, what did the US Fed had to do? It started raising the interest rates.
After months of aggressive rate hikes to tame inflation, Federal Reserve Chairman Jerome Powell told a Senate hearing Tuesday that the job's still not finished, warning lawmakers that the Fed may have to pick up the pace and size of interest rate hikes to get prices under control.
The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated.
When those interest rates started to climb, the value of those bonds started coming down. So, today, you have the specter that the Silicon Valley Bank, which was holding essentially US government papers, nothing more fancy than that, is a dead duck. By the way, the same risk of investing in US government papers can also haunt another very large constituency, Which is this constituency? The insurance funds, the pension funds. Remember, they invest hugely in these sort of safe government papers. Who are the others who have invested in the US government papers? The different central banks of the world. But the risks there are lower because all of them don't line up at the same time to redeem their deposits. But in a bank, as it happened with Silicon Valley Bank or with Signature Bank, when depositors suddenly become scared, the result is a run on the bank. So now what are the options for the US or rather the US Fed? Well, the one option is to continue with business as usual. And if it does so, then it will raise the costs even further. It has already raised the interest rate by 500 basis points in the span of 1.5 years, which means many other banks with holding the same government papers will suddenly find that their assets are starting to also look wobbly. The US Fed has to keep looking, therefore, at the rear view mirror to see which guy has further toppled off or who looks like toppling off. Now, that's a bad situation. So, what's the other alternative? The other alternative is for the Fed to stop raising the interest rate. As this news article shows, that is looking a possibility this time. But remember now what will happen. The reason why the Fed was raising the rates was because inflation was high. If instead of raising rates, the US Fed instead holds rates, then what does that mean? Well, that means that the dollar printing machine, excess dollars, the QE, has again got started. Is that going to happen? Well, just today, the joint statement of the FDIC, the US Fed and the US Treasury says that there will be what is called a bank term funding program, essentially a backstop, a financing program to ensure that banks don't run into problems. It's something similar to 2008, except that now the numbers may not be that high. Worse, both ways, this episode could badly hurt the reputation of the US Fed. And remember, the US Fed stands behind the dollar. When the dollar wobbles, it causes disturbances around the globe because there are no other currency as of now to replace the dollar. As we had discussed in one of our earlier episodes, Indian rupee is being internationalized, but those steps will take time, and neither euro or the pound is particularly strong to take the place of dollar. So what is the impact on the real economy? Well, the real economy gets impacted because the startups will find that their cost of cash has risen and many of them will go under. These are not just tech startups. Many of them are solving very real problems for the economy. And if they go under, that doesn't look good for the economy at all. But that's only for the USA. It will also happen for India, and we'll come down to that in a moment. But as we have said, all this is essentially a problem that is created by, yes, subsidy. When subsidies rise, subsidies create trouble. And it's not just only India which has had problems with subsidies. As we can see here, it is a subsidy problem happening in USA. So what does it mean for countries like India and other emerging market economies? Well, actually during COVID, these economies had been much more responsible. They didn't splurge cash. The result is in India, while inflation has risen, it has not risen at the scale at which it did in USA and in the Europe. It has risen mostly because of the global supply shocks. Nothing particularly wrong was done by the Indian economy's managers, and that's something remarkable. But, and this is a big but, that when all that good work has been done and you expect the economy to actually reap the rewards of that good work, that is coming asunder because, as I said, of this subsidy problem in USA. So what we are seeing is again a rerun of a very old film. that a disturbance in the heart of the US economy ripples out and affects the rest of the world economy. And that is not particularly good news. It is also not good news because last week China has begun relaying the architecture of its security market regulator, of its banking sector regulator. Remember, just last week again, its chairman, outgoing chairman of the People's Bank of China, has been reinstated in the post. The Chinese banking and in the security market regulator has been redone, and there is a new organization reporting directly to the state cabinet, which will take up its place. Now, all of these comes as China comes out of the COVID impact. Till the reorganization is over in Beijing, expect that country to remain distracted. So you have the world's two largest economies in a financial jam at the same time. What does it specifically mean for India? Remember, today, India is very strongly part of the world economic structure. India is the home for the third largest cohort of startups in the world. All of them will be affected by these disturbances. That's not good news. What's also going to happen is, as the contagion effect spreads, and no matter whatever the US Treasury Secretary may say, the contagion effect is spreading, this episode will certainly push the US into a recession. We are not talking about a soft landing anymore, and that means bad news for our exporters. For our markets, it will also mean an initial flight of capital. Why? Because those companies, those FIIs will be making up for their losses made in the US market. And that will mean a difficult time for the Indian companies trying to raise money here. But our prudent housekeeping will help. And that is a big optimistic note on which to sign off in what promises to be a very hot summer this time.